Thank you. Thank you so much for inviting me to give the talk. So yes, this is a paper that's about how natural disaster risk is being priced in financial markets. And if we start from a very big picture, one of the main roles that financial markets play in our society is that it enables risk sharing among different groups of people, which potentially can be, welfare improving for everyone. However, recent literature in asset pricing recognizes that frictions in financial intermediation can disrupt this risk sharing process. And as a result, a large quantity of risk can be concentrated within the intermediary sector. And as a result, the asset prices may end up reflecting the risk exposures of these concentrated intermediaries rather than those of broad end investors in the economy. Now, that sounds very intuitive, but testing this empirically is actually very challenging because of the standard omitted risk factor problem. Because if you want to establish this, it's not enough for you to show that intermediaries' risk exposures co-vary with asset prices and risk premium, but you also have to show that the risk exposures of everyone else, all the other investors, is not co-varying with those prices. And in normal situations, that's very hard because ultimately many of the most important risks in the economy are ultimately driven by the same macroeconomic forces that's affecting everyone. So this is where this paper comes in. In this paper, I test these ideas in a market that I argue is uniquely well suited to tackling this type of empirical concerns. And in particular, I study catastrophe bonds or CAT bonds that are securities whose cash flow risk is directly related to the occurrence of natural disasters like hurricane in Florida or earthquake in Japan. I'm going to argue that the relevant financial intermediary in this market is a specialist CAT bond fund manager, essentially a specialist fund manager who manages CAT bonds on behalf of their end investors, like pension funds and sovereign wealth funds, and don't really invest in other markets, which causes them to have a risk concentration in this particular space. My main finding in the paper is that over 70% of security level variation in expected returns for CAT bonds can be explained by a theoretically motivated measure of these intermediaries' marginal rate of substitution or their risk exposure. And I'm also going to argue that to the extent that the occurrence of these natural disasters is uncorrelated with whatever is happening in the macroeconomic level, the findings that I have would be inconsistent with any type of a reasonable omitted risk factor explanation that you might have in mind. So let me spend a few minutes talking about the basics of CAT bonds for those that have not had prior exposure to this. So the market started first in like late 1990s as an alternative to traditional reinsurance contracts. And the way the bond is structured, that after the issuance, the proceeds are being put in a collateral account. The issuer pays periodic coupons to investors. But if a qualifying natural disaster occurs, the bond will trigger and investors will lose their money. So essentially, investors are selling disaster protection to whoever issues the bond. And importantly for my study, these bonds are intentionally constructed in a way that minimizes traditional fixed income risk exposures. They're floating rate notes, so there is little interest rate risk, and they're fully collateralized, so the traditional credit risk is also very low. If the issuing company gets into financial distress due to some other reason than a qualifying natural disaster, the investors will still get their money back because it's fully collateralized. A typical issuer for a CAT bond is an insurance company that wants to buy reinsurance protection against their exposures, but also reinsurance companies can use these for retrocession protection. Government agencies and governments also have been using this in some particular instances. At the moment, CAT bonds and other related securities are around a little bit more than $100 billion in terms of market size, which is like 15 to 20% of the global reinsurance market. So it's just become an important component of the market. So let me next. Before I go there, Another important detail about cat bonds that will be important for my empirical analysis is that whenever an issuer chooses to issue a cat bond, it hires one of these three cat risk modeling companies whose job is to assess the actuarial risk that the bond is exposed to. What is the probability that if an investor buys the bond, there will be a qualifying event next year that will cause the bond to trigger? And so these risk models, to some extent, they're nice in the sense that they are built based on the underlying physics of these natural disasters occurring, which means that they can at least to some extent be forward-looking. If I think that next year the surface seawater in the Atlantic Ocean is going to be higher than what the average level historically has been, I can tweak the parameter in the model because now the hurricane formation will be higher. That will capture partially any those type of increases. So this modeling effort is summarized in the bond prospectus using three risk measures called attachment probability, expected loss, and exhaustion probability. I'm going to come back to these measures in just a little bit in my summary statistics. But before that, let me give you three motivating facts about this market that will be relevant for my analysis. The first fact is that investing in cat bonds historically has been extremely profitable for investors, despite very low correlation with other asset classes. So here the blue line shows the cumulative excess return on an index of catastrophe bonds. And then we have the US equities in orange and high yield corporate bonds in green. So you can see that historically speaking, the premium on cat bonds have been of similar order of magnitude that we have seen in the traditional asset classes, which in itself wouldn't necessarily be surprising if the risk is very high. But the problem from a traditional asset pricing perspective is that it's not only that the premium is very high, it's also that the correlations are very, very low. Cat bonds have virtually no correlation with other asset classes during the past 20 years in terms of their realized returns. And the reason why this is the case, can be kind of easily understood because the way the bonds are being structured. So whenever you see a major natural disaster, let's say Hurricane Ian in 2022, that will cause some of the cat bonds in the market to trigger, causing losses to investors. And even though Hurricane Ian can cause large damages locally, the damages that we have historically seen with these type of events are still orders of magnitude smaller than what we typically consider being relevant at the US or the global economy level as a whole. And as a result, if a natural disaster occurs, we don't really see stock markets or bond markets to respond to these type of events. And vice versa, the bonds are intentionally constructed in a way that they are not affected by macroeconomic events. So if we have a financial crisis, we have COVID, we have a period of high inflation, stocks and corporate bonds are going to suffer, but cat bonds not really, and this is by design. So now we're facing this problem that we have an asset class with very high risk premium, with very low correlation with other asset classes, which is very difficult to understand from the perspective of traditional asset pricing theory. And this is what I'm going to explore in this paper. Why do we see this happening in practice? So one objection you might have with this particular graph is that you're only looking at a 20-year time period. When it comes to natural disasters, the probabilities are significantly lower. So perhaps we never saw such a big disaster that it would have like an economy-wide impact or whatnot. So for that reason, I'm extending my analysis. I'm looking at 13 developed economies since 1950s. And I'm essentially estimating impulse responses on what happens to various macroeconomic quantities like consumption growth, GDP growth, house price growth, and stock market returns in a country after a major natural disaster compared to other countries out there. So in the year zero, there is a major disaster in one country. And what I'm estimating is that how are these quantities going to develop differently in that particular country compared to the other ones after that disaster. And as we can see at the economy level, we don't really see a huge impact, even though the disasters are very important locally. Again, in terms of the economy level as a whole, it doesn't seem to have all that of a major impact. Last fact, and this is not my own, is that the ownership of cat bonds is extremely concentrated. Something like 60% of cat bonds are being held by these specialist cat funds who specialize in this market and don't invest in any other asset classes. And in fact, this graph is probably underestimating their importance because these cat funds also offer managed separate accounts for their institutional clients. So in fact, many of this institutional money is actually going to be directly managed by the cat fund managers as well. So also, if I don't unfortunately see their actual holdings because they are hedge funds and the holdings data is very opaque. But if I compare the reported quarterly returns to returns on a well-diversified portfolio of outstanding catastrophe bonds that I construct myself, you can see that the two are very highly correlated. So the main group of investors in this market really seem to be focusing on cat bonds and not other asset classes. Okay, so here's a few summary statistics from my sample of cat bonds. The first thing quickly is that the average time to maturity of a newly issued cat bond in my sample is around 3 years. So these are not very long-term contracts. The credit spread above the risk-free rate or the benchmark rate is around 7%. So which means that, you know, if I'm an insurance company, I want to buy a protection worth $100 against natural disasters, I have to pay $7 premium reinsurance premium essentially every year to maintain that protection. Obviously, some of that premium is going to be compensation for actuarial expected loss. But if you look at the average bond in my sample, the expected loss in percentage terms is only 2.4. And what it means that the cat bonds that we have are offering protection against relatively remote layers of disasters. So you need kind of like a 40-year storm or 40-year earthquake so that the average bond in my sample would actually start to experience losses. And what it means that if you take this actuarial model's loss estimates at their face value, it means that if you take the credit spread and you subtract this expected loss, the difference between those two is going to be price or compensation for holding this risk above and beyond what you can expect to lose by investing in these bonds. And in my sample, it's around 5.3% annual expected return above and beyond expected actuarial losses. Okay. So with this in mind, what I'm going to do next is in the paper, I construct a simple general equilibrium asset pricing model with financial intermediation frictions. And without going too much into the detail, there is kind of like 3 components that I use here. I assume that the only investors who have direct access to cat bonds are the specialized cat bond fund managers. If other investors want to participate, like pension funds and sovereign wealth funds, they have to do so through these cat funds that are out there. Then I'm going to introduce an intermediation friction. I'm going to assume that the outside investors require the cat fund manager to have skin in the game, meaning that they need to tie a significant amount of their own wealth to their own fund that they are managing. You can get the same result if you assume that the compensation of the fund manager is very heavily tied to the performance of his or her own portfolio. That just makes sure that the fund manager cares about the performance of his or her particular portfolio much more than what the outside investor does. And then the key assumption I'm making to make sure that the outside investors' risk exposure is not what's driving the prices is I'm going to assume that natural disasters are independent of the marginal value of aggregate wealth. So from the perspective of a Norwegian pension fund manager, I'm assuming that if there is a hurricane in Florida or earthquake in Japan, it's not going to be affecting the rest of his portfolio that is mainly tied to equities and other asset classes. So with this, I get predictions both for the cross-section and time series of cat bonds prices. In the cross-section, I get a very simple kind of like a CAPM type of a prediction. The expected excess return on any bond I is going to depend on 2 components. The first component is what I call a cat market beta. It's a measure of how correlated that bonds return are compared to all the cat bonds that are currently outstanding. And then it depends on the level of the risk premium. That's the same for all bonds in particular point of time. And in fact, that risk premium in the market is on the other hand then directly related by this equation over here. And what's essentially driving it is how well capitalized the cat bond fund managers are. If the size of the cat bond market, the supply of bonds is very large compared to the assets under management that the fund managers have, they are going to be more capital constrained. They need to lever up their portfolio in order to buy all the bonds that are being offered to them, and that drives up the risk premium in the market. If, on the other hand, they're going to attract lots of outside capital and they are very well capitalized, they have lots of dry powder, that will then drive down the premium and the overall reinsurance will be cheaper. Okay, there is many technical challenges in terms of implementing these ideas. And in particular, I cannot use the standard asset pricing methods to estimate these betas and other quantities like what previous literature has done. And instead, one of the technical innovations in this paper is I'm going to propose an alternative way of measuring the systematic risk exposure. And the way I do it is that I take advantage of these cat risk models that are out there. They give you a very good understanding of what is the forward-looking risk loss distribution of each individual bond. So I'm going to simulate natural disaster losses across the world. I'm going to calculate what is the holding period return on any individual bond given those realizations of natural disasters. I'm going to repeat this 500,000 times, and that gives me enough data to estimate the betas of these bonds from the simulated data. And empirically, the variation in this risk measure beta that I construct is essentially driven by two things. The first is that the higher the bond's expected loss is, the higher the beta will be. If I have two bonds that are both exposed to Florida hurricanes, but one of them will trigger if a 20-year storm hits, and the other bond will trigger if a 100-year storm hits, the one that has a higher trigger probability will also have higher beta. It's more systematically risky. But if I now take two bonds that have the exact same quantity of risk, let's say one in a 20-year storm, but one of them is exposed to Florida and the other one is exposed to, let's say, Japan, from the perspective of the cat fund manager, the Florida bond is going to be more systematically risky because if a 20-year hurricane hits Florida, many bonds in his portfolio will trigger at the same time because many bonds are exposed to that particular risk. There's a big concentration of that risk. And on the other hand, there is relatively few bonds that are exposed to Japanese typhoons. So even if the underlying quantity of risk is the same, this is more of a diversifying risk category to that market portfolio that the fund manager is holding, and everything else equal, that constitutes a lower systematic amount of risk for him. So here's the results in the cross section. So each dot here represents one particular cat bond in one particular time period. In the y-axis, I'm plotting the observed premium. Again, it's the credit spread minus the actuarial expected loss, what the investors require. And then on the x-axis, you see the predicted premium based on my model. And as you can see, it seems to be fitting the data quite well. And also it fits very well in terms of the kind of like the anecdotal understanding how we think these bonds are being priced. If somebody offers an investor in this market a 20-year storm bond in Florida, investors look at that bond and say, I already have lots of Florida bonds in my portfolio. I'm going to require a very high premium for holding that. On the other hand, if you're being offered a 20-year storm bond in Japan, investors say that, oh, very few of my bonds are currently exposed to that risk. I'm willing to offer protection at a much lower premium. And while this is optimal from the perspective of the fund manager, from the perspective of the economy as a whole, it's actually suboptimal because there would be much more risk-sharing capacity available had this intermediation friction not exist. So from the perspective of a Norwegian fund manager whose money is mainly tied in equities, he should be basically indifferent in terms of whether he's providing protection against Florida or Japan, because both of those risks are idiosyncratic with his perspective. Neither of them is correlated with equities or corporate bonds that he's currently holding. I'm going to skip the tabulated results and move on to the time series results. So here what I'm plotting is how the premium on cat bonds has evolved over time. The shaded regions are years when we saw major natural disasters. And you can see during my sample period, overall, the premium has kind of been drifting downwards. If I compare that to the predicted premium, which is the size of the cat bond markets divided by the amount of capital that these cat funds have, you can see that it does a pretty good job of capturing the overall time series evolution in the premium. Anecdotally, what has been happening during 2010s is that when interest rates were very low, many pension fund managers and others started to look for alternative ways to boost their yields, and lots of new capital flew into these cat bond funds. They became better capitalized, which pushed down the premium. Unfortunately, the data source I used was discontinued here. I would really like to update what happened afterwards. Anecdotally, this trend has kind of shifted. The premium has increased over the last few years. Many investors have kind of exited the market because they got scared by the large recent losses. And if that's the story, it will be very much consistent with the prediction of this model. Okay, then I do some pooled regressions that also point to the same direction. Finally, one of the important contributions of this paper that nobody's probably going to read is I have a very long online appendix where I show many alternative hypotheses that could explain the pricing, but actually do not. But from the perspective of this particular conference, the one alternative that is probably most interesting is to understand to what extent growing climate change concerns might explain the level of risk premium in this market. And I'm not saying it doesn't have any effect, but if you look at the aggregate pricing patterns, I'm also arguing it's probably not the main driver of the premium in this market. And in particular, if you now split the sample to those bonds that are only exposed to hurricanes and those bonds that are only exposed to earthquakes, you see that the historical time trends are in the both samples very, very similar. Presumably, earthquake bonds are not exposed to climate change. We get this exact same result in the cross section as well. So at least historically, remember that any predictable increase in temperatures, things like that, are controlled here through those actuarial models, but in terms of the premium, it doesn't seem to be historically being the main driver of the price. But that doesn't mean that climate change is not relevant for these findings, because what these findings say is that if in the future the quantity of risk that we need to share grows up, we need more risk sharing capacity, and cat bonds and other markets could potentially provide that risk transfer. But if there are intermediation frictions in this market, we need to first solve those so that the market can intermediate this risk as efficiently as possible. A quick shout out to my upcoming work with Sean. We are actually at the moment looking at, okay, let's suppose that there are frictions in the reinsurance market and the prices are too high from insurance companies' perspective. We try to, understand to what extent, if you alleviate the frictions here and make the reinsurance protection more accessible and less expensive, to what extent that could help alleviate the prices for the end users in the home insurance market. So to conclude, I showed you a model of with intermediation frictions that can explain the premium on natural disaster risk, both in the cross section and time series. And what this implies is this friction implies that there is kind of like a failure in risk sharing. There's too much concentration of risk for these intermediaries, and as a result, the price is too high. We need to figure out a way to distribute this risk more evenly to a larger group of investors. Natural disaster damages globally are very large, but they are very small compared to the total wealth portfolio that the investors have available to them. So if we can get more investors taking a small quantity of this risk as a diversifying asset to their portfolio, that, according to the theory, should ultimately make the premium more accessible and the market more efficient. So with that, I'd like to thank you all for your time and attention. I'm really happy to take your questions.
Questions? Hi, Kesh Hotsky again from Morgan Stanley. So I didn't quite understand the source of the friction. So you are saying that concentration or intermediary is too much, and then of course the diversification would help. So what is actually preventing from moving to the more diversification?
Right, great question. So I've actually asked, several friends of mine who manage pension portfolios and whatnot, and I told them that look, there's a great investment opportunity here, very high expected returns, low correlation with your existing portfolio, so perhaps you want to put a little bit of your money here. And the typical answer that I get is that look, it looks great. And if I invest and I get lucky and I don't get hit by these storms, I can improve my portfolio a little bit. But the problem is that if I get unlucky and the storm hits, I will get lots of second guessing from my boss and everyone else. Did I really understand what risk I'm taking here? Did I really do my due diligence? Because I'm not an expert in natural disaster risk. And as a result, it's easier for me to outsource this to specialist funds who focus on this particular market instead of trying to do this by myself. So with that, kind of like educating more investors about the opportunities you have in this market might help with them.
Very interesting. As a risk manager, I
definitely understand the psychological challenge, because as a fund manager, it's one thing for you to lose money when everybody else is losing money, right? If you are singled out, then that risk equation is a much more challenging one for the fund manager. So I understand why, but that's a very difficult one to solve.
Agreed. And and to me, in the broad picture, we just need more awareness, more education when it comes to these things. I'm teaching investments for undergrad at Boston College. I'm not talking about cat bonds. I talk about equities and fixed income and options. So introducing like a half a lecture on this particular topic, increasing awareness might be like one long-term way to make the market more accessible and understandable for a larger group of investors.
I mean, it seems like once you diversified this, though, you're not going to be faced with such big risks or so such big tails, I guess is really what it is. So why can't we have ETFs or something like that set up to have a wide spread of these cat bonds?
Right. So that's actually another
funds, I guess, would be.
Yeah, absolutely. Like part of the challenge is that at the moment the risks are very concentrated in Florida and California. There isn't like enough foreign risk that would act as a diversifier in this particular market. So essentially, if you set up an ETF, you would be selling, Florida and California exposure, and that, might be not very attractive for many investors. But I agree, it should be probably part of the solution.
So is that because the actual demand for risk transfer is concentrated in Florida and California, or is that because somehow the market has developed, particularly around that area?
Right, that's a good question. And to be honest, I don't know the 100% answer to this question in terms of where the exposure is. But one thing I do know is that if you look at developing countries, there is a huge insurance gap in those places in terms of what the potential losses are versus, what is currently being insured. So World Bank is actually currently trying to help these countries to issue cat bonds, and that shouldn't only make those countries better off, but it should make the whole market more healthy in terms of achieving a little bit more diversification.
Any idea on the issue size? The usual issue size and how homogeneous those bonds are? Indentures and the size of the market?
Yeah, so the typical bond is around 120 million. And then it varies from like very small 10 million to up to like a few $1 billion.
Any idea on the size of the market?
So cat bonds and
index, for instance.
So my index, it doesn't contain all cat bonds because I don't have data for particular types. In terms of the whole market, cat bonds plus collateralized reinsurance and other similar contracts that are all traded in this market. It's around 100 or 120 billion now.
Do you have any idea as to the degree to which the existing issuance there is taking up the possible application of these bonds?
Excuse me, could you repeat?
So is this, could this be 10 times as much as it is within our current market, or is it about taking care of about what it could do?
Right, very good. So the whole reinsurance market is around 600 billion. So that would kind of give you the upper bound in terms of what is currently being traded. But to be honest, I don't think cat bond is a one-stop solution for all type of reinsurance contracts. The more bespoke contracts you need, the better off you are probably negotiating a bilateral trade with that reinsurance. But then if you talk about various types of uninsured risks and risks that are currently being held by somebody's book that wouldn't necessarily want to hold it, my sense is that quantity is much larger and there would be room for expansion.
Did you look at the attachment points themselves in terms of how well these bonds are priced and how they're rated?
Yes, so I actually look at this because one potential explanation for the premium that I observe is perhaps the cat models are just very bad and investors understand that the true losses are much higher. Let's see. But here is a graph which shows you that if you take these cat models as their face value and you put your money in a well-diversified portfolio, this black line here shows you how the cumulative losses should have occurred over the sample period. And then if you compare that to the actual losses, which is given over here, you can actually see that the two are like tremendously close to each other. So this gave me a lot of confidence in terms of using these cat models that they actually do seem to be working the way they are supposed to. There's lots of uncertainty in terms of what the actual losses are in any given draw because of natural disasters being random. But actual losses and the projected ones were actually very close in this particular realization.